Unlock your home's potential. HELOC explained. Need cash? Don't want to refinance your home? A HELOC might be the perfect solution. Hi, I'm Kris McCullough. Today we'll break down HELOCs and see if they're right for you. What is a HELOC? HELOC stands for Home Equity Line of Credit. It's a revolving credit line. It's secured by your home equity. Home equity is the value of your home minus what you owe on your mortgage. Think of a HELOC like a credit card. You can borrow money, you can repay it, you can borrow again. This is during your draw period. A HELOC doesn't replace your existing mortgage. You only pay interest on the amount you borrow. HELOCs offer flexible and low-interest financing. How does a HELOC work? There are two main phases, the draw period and the repayment period. Each phase has its own unique features and requirements. Draw period. This typically lasts 5 to 10 years, depending on the terms set by your lender. You can borrow money as needed, up to your credit limit, similar to how a credit card works. You can make interest-only payments during this time, which can help manage your cash flow. Some lenders may require a minimum payment amount, so it's important to read the terms carefully. Repayment period. This follows the draw period and usually lasts 10 to 20 years, depending on your agreement. You can no longer borrow money during this period, as the focus shifts to repayment. You start repaying the principal and interest, which can increase your monthly payments. Example. Let's say your home is worth $500,000. This value is crucial for determining your HELOC limit. You owe $400,000 on your mortgage, which affects your available equity. You have $100,000 in home equity, which is the difference between your home's value and your mortgage balance. You qualify for a HELOC with an 80% loan-to-value ratio, a common standard among lenders. This means you can borrow up to $80,000, which is 80% of your $100,000 in equity. This flexibility can be very useful for various financial needs. Pros and cons of using a HELOC. Like any financial product, HELOCs have pros and cons. Pros: lower interest rates. HELOCs usually have lower interest rates than credit cards or personal loans, making them an attractive option for many. Flexible borrowing. You can borrow as much or as little as you need when you need it, giving you control over your finances. Interest-only payments during the draw period. This can make HELOCs more affordable in the short term, easing your financial burden. Use for anything. You can use HELOC funds for home improvements, debt consolidation, education expenses, or anything else that requires funding. Possible tax benefits. You might be able to deduct the interest paid on your HELOC if you use the funds for home improvements, which can save you money. Variable interest rates. HELOC interest rates are usually variable, meaning they can go up or down over time, adding uncertainty to your financial planning. Risk of foreclosure. If you can't repay your HELOC, you could lose your home, which is a significant risk to consider. Temptation to overspend. It's easy to overspend with a HELOC because it's like having a large credit card, which can lead to financial trouble. Advice: use a HELOC wisely and have a solid repayment plan to avoid potential pitfalls and make the most of its benefits. HELOC versus cash-out refinance. Which one is right for you? Let's dive into the details to help you make an informed decision. Both HELOCs and cash-out refinances let you tap into your home equity, providing you with access to funds that can be used for various purposes. However, they work differently and are better suited for different situations, depending on your financial needs and goals. HELOC. Choose a HELOC if you need flexibility and might not need all the funds up front. This option allows you to borrow as needed. It's good for short-term needs, like home renovations or debt consolidation, where you can draw funds over time. Cash-out refinance. Choose a cash-out refinance if you need a large one-time sum of money. This option replaces your existing mortgage. It's good for paying off high-interest debt or funding a major expense, such as buying a new car or paying for college tuition. To qualify for a HELOC, you typically need to meet certain criteria set by lenders. Home equity. Most lenders require at least 15 to 20% equity in your home, ensuring you have enough stake in the property. Credit score. A good credit score is essential, usually 620 or higher, to qualify for favorable terms. Debt to income ratio, DTI. Lenders prefer a DTI ratio below 45%, indicating you can manage additional debt. This means your total monthly debt payments should be less than 45% of your gross monthly income, ensuring you can handle repayments. Stable income and financial history. Lenders want to see that you have a steady income and a good track record of managing your finances responsibly. Ready to unlock your home's potential? Check your home equity today. It's free and easy. Contact us for a free consultation. We're here to help you make smart financial decisions.